Hello students, now let's start with our next module, that is week 11. In this module we are focusing on asset pricing models. Other than that we have talked the previous topic, that is asset pricing 1. In this module we are going to cover various other models that has been used by researchers and academicians for the understanding of what is the behavior of stocks during different period of time and during the other factors when collaborate with it. So under this lecture, we are focusing on arbitrage asset pricing model. So arbitrage asset pricing model, under this we are going to cover its introduction, its features, difference between CAPM model and arbitrage pricing model, the basic assumptions, the interpretation of asset pricing model, advantages and limitations, application and some numerical examples. So what is arbitrage asset pricing model? But before focusing on arbitrage pricing model, we need to understand what is the difference between CAPM and APT. In CAPM, you have gone through what are the major factors that affect the stock prices, and we are able to understand that market returns are the basic factor which affect the stock prices. So on the basis of that, there are certain models that had been developed. It is further elaborated with the help of single index model. But when we talk about asset pricing models, there are certain factors other than stock market which has been covered under this arbitrage pricing theory. Arbitrage pricing theory is basically propounded by Stephen Ross, which is an extension of CAPM model, or we can say which take the base of CAPM model and criticize it and further try to develop it in a better manner so that we can capture the impact of various factors that affect the stock prices. Basically here he focused about the macroeconomic factors other than market returns. So APT propounded that asset prices can be explained by multiple systematic risk factors rather than a single market factor. In CAPM and single index model, we have focused on market returns, that is denoted by RM. So we are focused on that particular thing only. But here we are focusing on other factors like inflation. Depending upon the situation, researchers have elaborated with other factors also. So inflation is one of the common factors that has been used. Then the interest rate that is prevailing in the market, GDP. So there are various factors which affect the stock prices. So in this particular APT model, Ross has propounded that we should think about the multiple systematic factors that may affect the stock prices, and we need to understand how they are impacting the stock prices. With the help of this model, we can simply say that if we apply it in recent researches, we can say that how the market or economic factors affect the stock prices. He is focusing on the market factors that are totally beyond the control of individual investors, and they are affecting the stock prices. So with the help of the market factors, he is trying to elaborate it in a proper manner. So what is this particular model states that the asset returns can be explained with multiple systematic risk factors rather than a single market factor, that is stock market return, offering a more flexible and nuanced framework for understanding the expected return. What we are actually calculating? We are calculating the RI value. So what are the factors or what are the macroeconomic factors that are basically affecting the stock return? We are basically calculating that particular thing with the help of APT model. So APT is based on the principle that arbitrage opportunities do not exist in efficient markets. We already know the characteristics of efficient market. The basic characteristics of efficient market is that all the information are available to investors. So there is no opportunity available to investor to, with the help of that information gap, they can make abnormal profits because the markets are efficient and all the information are available in the market. But there are chances that the flow of information may be little bit difference, or suppose the broker has a better understanding about the information, normal investor doesn't have. In that particular time frame, the broker can make a abnormal profit, and after a point of time that particular abnormal profit got dissolved because other investors able to understand what is going in the market. So if an asset is mispriced relative to its risk exposure in the sense what are the systematic risks, arbitrageurs will exploit this mispricing until the market prices adjust to align with its expected return based on the underlying factors. So in simple we can say if there is an arbitrage process available, in arbitrage process what happens? Suppose there are two stocks that are suppose in BSE and NSE. A stock name A is listed in both the exchanges, and there is a chances that in BSE it is trading at suppose 221 and NSE it is listing at 224. It is at present the current market prices, the stock A is different in both the markets. What the arbitrageurs are going to do? They are using with the arbitrage process and try to correct this mismatch, and between this mismatch whatever profit is available they earn that particular profit, and with the passage of time, or we can say with a period of 1 day or 2 day, this particular process got dissolved and stock prices automatically come to an equivalency and arbitrage process has been completed. So this mispricing is not available in case the market is efficient, and the APT theory states that due to systematic factors there are chances that sometime arbitrage is available to the arbitrageurs and they can try to manage this mispricing of the stock and make the market again efficient. So what are the basic features of this approach? This first is multi-factor approach. In CAPM and in single index model, we focused on only one thing, that is market returns. Here we are focusing on multiple systematic factors like inflation, interest rate, GDP, etc. So it depends upon the researcher or depends upon the fund manager. He can use different factors to understand how this systematic factors are affecting the stock prices. So we are concerned about the multiple factor approach. So APT's flexibility comes with the fact that it allows multiple factors to influence asset prices. Previously we are focusing on single, in this we are focusing on multiple factors, making it more adaptable to different markets and asset classes. Factors can be macroeconomic variable, industry variable, or even technical factors based on empirical analysis. So researchers can conduct empirical analysis on the basis of APT model, and they can use any sort of factors. It may be technical factors like moving average, or they can take the prices of different stocks and how they are affecting the prices of this particular stock, or they can simply take the index factors. So depending upon the technical factors, depending upon the industry factors like industry average, industry growth rate, researchers can conduct the research. Simply we can take the macroeconomic variables, because Rose has propounded that we can simply take the macroeconomic variable and evaluate the impact of this variable on the stock returns. No market portfolio requirement, because we are focusing on macroeconomic factors, so we are not concerned with the market return here. Like CAPM, APT does not require the identification of market portfolio, addressing a key limitation of the CAPM, because in that we need to focus on market return and in which particular index the particular stock is listed. On the basis of that we are going to calculate various things like this premium is also calculated. So there are certain things which are required in CAPM, and it becomes a criticism of CAPM which Ross has tried to mitigate with the help of APT model. Focus on systematic risk only, because we are concerning about the market factors, we are focusing on systematic risk. So APT emphasizes systematic risk factors that cannot be diversified away, providing a clear separation between systematic and idiosyncratic risk, because we are trying to differentiate. If we are interested in industry based factors, in that case the scenario will be different. If we are trying to identify the impact of macroeconomic factors on stock return, the equation is same, but the characteristics or the measurement method will be different, because in one aspect we are focusing on systematic risk factor and in another aspect we are focusing on the industry based factors or unsystematic risk factor. So this way we can differentiate on the basis of which we want to calculate the particular model and what are the impact of this particular factors return of the stock. Now coming to difference between CAPM and APT. I think you people are clear about the CAPM model and what's the difference between APT. In CAPM model, we are focusing on the impact of market returns on the stock prices. Here we are focusing on the systematic factors and its impact on the stock prices. So now what's the basic difference between the two? The first is factors. In CAPM, we are focusing on single factor, that is market risk. In case of APT, we are focusing on the multiple factors, that is macro factors and firm specific factors. So if you are interested in calculating the impact of GDP, inflation, interest rate, money supply and what's its impact on the stock prices, then we are concerned about the systematic risk and focusing on macro factors. Suppose we are concerned about industry average, industry growth rate. In that case, we are concerned about specific factors. Or we can take certain ratios and its impact on the stock return. That can also be done. So, in that case, we are focusing on the unsystematic risk. So, we can calculate on two categories, that is on systematic risk factors basis or on the basis of unsystematic risk. So, it is depending upon the requirement and depend upon the researcher and the fund manager how they are going to evaluate the expected return of a particular stock. Then risk measure. We have already mentioned we are focusing on systematic risk with the help of beta. Here specific factor betas have been calculated. Suppose we are taking interest rate, GDP, money supply into consideration, then we have to calculate the betas of this particular variables also. So, in case of CAPM, one particular beta is calculated. Here multiple specific betas have been calculated. Assumption, more restrictive because we are focusing on single period and assume that markets are efficient. Here it is less restrictive because we are focusing on that there is no arbitrage condition, because market may be efficient, market may not be efficient, but we believe that if the market is inefficient, it try to be efficient with the help of no arbitrage process. That in case of investors, there is no arbitrage availability in the market. And if there is mispricing, arbitrators are going to handle that particular situation. Then flexibility, it is less flexible, assumes market risk is the only driver that drive the expected return of a particular stock. Here it is more flexible because we are considering various factors. It may be firm specific factors, it may be macroeconomic specific factors. So, depending upon the requirement, we are expanding this particular equation. Then market portfolio requires identification of market portfolio because we need to calculate it. Here there is no need for market portfolio, only factors are required on the basis of which we can evaluate the impact of this factor on the stock prices or stock returns. So, these are some specific differences between the CAPM model and APT model. Now, what are the basic assumptions of APT? The first one is efficient market. Like other models, it also assumes that in general markets are efficient, that asset prices quickly adjust to incorporate new information. So, whatever information is available, it is automatically reflected on the stock prices. And if there is a mismatch between the information availability and the stock price absorption, in that case, arbitrager will play the role and that particular inefficiency is dissolved in the market. So, no arbitrage opportunity. The primary assumption is that arbitrage opportunities do not persist in the market. If two assets have the same factor exposures but different expected returns, arbitrager will buy the undervalued asset and short the overvalued one. I have explained with the help of BSE and NSE where a particular stock A is listed in both the markets and how arbitrators have played their role and try to balance the prices in both the market. So, with the help of this, the arbitrager bring the prices in line until the arbitrage opportunity is eliminated. So, that is why it was called no arbitrage opportunity. If arbitrage is available, in that case every time the mispricing happens in the market. But for certain period of time, if arbitrage opportunity is available, arbitrators play their role and try to balance the securities and bring them in line, and further there will be no availability of arbitrage will be available in the market. Linear relationship. APT assumes a linear relationship between an asset's expected return and its sensitivity to the chosen factors. Sensitivity to the chosen factor in the sense we have certain factors like GDP, interest rate, and suppose money supply. These are the three macroeconomic factors. We have to identify the beta values of these particular factors and we call it as sensitivity. On the basis of that, we are going to calculate the expected return and how it is, what is the relationship between factors, or we can say different macroeconomic factors or industry factors, and the stock return. Then well-diversified portfolios. APT assumes as investor hold well-diversified portfolios which eliminates unsystematic risk, leaving only systematic risk presented by the factors. So, well-diversified portfolio, APT assumes investor hold well-diversified portfolios which eliminates unsystematic risk, leaving only systematic risk represented by the factors. So, we have gone through the MPT model also, that is Markowitz portfolio theory, or we can say modern portfolio theory, where we focused about the diversification. So, APT assumes that individual investors have a well-diversified portfolio, and that's why we need to focus on only systematic risk, because unsystematic risk can be eliminated with the help of diversified portfolio. So here, what are the macroeconomic factors or industry related factors which are beyond the control of an investor? They can try to understand that particular factors and what is its impact on that stock return, we can easily identify with this particular. So that is a basic assumption that investor must hold a well diversified portfolios. Then homogeneous expectation. Investors have homogeneous expectation about factor returns, variances and covariances, meaning they have a common view of the how factors will impact the asset return. So we know how GDP is going to affect the stock prices, how money supply is going to affect the stock prices, how interest rate. So every individual has certain assumption about these particular factors, how these are affecting the stock prices. So there is this homogeneous expectation should be there. Otherwise, if there is a heterogeneous expectation, in that scenario, we cannot identify the macroeconomic factors or systematic factors that may affect the stock prices. So since researchers have collaborated together and applied different sort of understanding in this particular model, they have tried to identify different factors and calculated the APT model. So they have some common list of identified factors which they think that these factors may affect the stock prices, and all the investors have certain particular view about this factor. If they have differentiated view, we cannot calculate this particular prices with the help of systematic factors. So we need to have certain homogeneous expectation from the factors. So now coming to what is the basic formula of APT model, that is E is the expected return, we already know. RF is the risk-free factors or risk-free rate. F1, F2 and Fn. So these are the risk factors which we are going to take in this particular model. It may depends upon the individual investor. And BI, BI2, BIN are the sensitivity, or we can say the beta of individual factors. Now having an explanation of this particular components of the formula is very important. So what is that? First is risk-free rate, that is RF. It is denoted by RF. So similar to CAPM, the risk-free rate represents the return on an investment that carries no risk of financial loss. That means if we are taking a T-bill or the government bond, it is having a risk-free rate of return which we believe that it is free from any sort of risk, and basic requirement of any investor is that if it is 5% or 4% or 6% RF, he should get above this particular risk-free rate of return. So typically represented by government bonds, it accounts for time value of money of the investor. Then risk factors, that is denoted by F1, F2, Fn. APT allows for multiple factors that can drive asset returns, unlike CAPM, which relies only on risk factors. We have already gone through the basic assumption. We have understand that in APT we are focusing on multiple factors. We are not focusing on single factor. So risk factors can be Suppose F1, it can be denoted by interest rate, F2 GDP, F3 inflation rate. So these are certain risk factors that have been taken into consideration. Then sensitivity coefficient, that is denoted by Bij. In previous equation, if we go through, that is Bi1, Bi2, Bin. So here we are talking about beta 1, beta 2, beta in. So that is denoted by basically Bij. So what is that? Similar to beta in CAPM model, it is concerning with the sensitivity, represents the sensitivity of asset to each specific factors, because in CAPM we are focusing on only beta RM. Here we are focusing on different factors like interest rate, GDP, inflation. I am going to explain it in a better manner with the help of an example, so you will be able to understand in a clear manner. Yes. So we are focusing on the sensitivity of specific risk factors. Suppose in an equation you have taken sensitivity of GDP, inflation, money supply, or any other specific factors like industry related factors like industry growth rate or industry GDP. In that case also you can calculate with the help of this particular formula. So a beta of 1.5 for a factor indicates if the factor increases by 1%, the asset's return is expected to increase by 1.5%. The sum of factor sensitivities multiplied by respective factor risk premium gives the expected excess return over the risk-free rate of return. So with this we can identify what is the risk premium that is available to the investor and how much is earning is sensitive to the systematic factors that are governing in the stock market. Then coming to the interpretation of APT, that is higher expected returns for higher systematic risk. So according to APT, an asset's expected return is a function of exposure of systematic risk factors, with this its own risk premium. So where we are calculating the risk premium as well as the individual risk factors rate of return. So from that we can calculate how much premium value is added to the total asset. So the more sensitive an asset to these factors, the higher its expected return should be. So if we know that inflation is going to affect the stock prices badly, in that situation we can say that particular asset is sensitive to inflation. Suppose a particular asset is highly related to the interest rate. In that case we can correlate that these two factors are positively, these two, that is means stock prices and the interest rate is correlated in context of particular stock and they might relate in a particular manner. And in that situation, if the stock prices get affected by the interest rate, we need to take a notice of that particular thing. Based upon investing, the model suggests that investors should focus on understanding factor exposure to better predict asset returns rather than solely on the market beta as explained in CAPM model. So we need to consider other factors also that may affect the fair pricing. APT helps identifying whether an asset is fairly priced based on its factors. Sensitivities if actual returns differs from the expected return. It indicates potential mispricing and arbitrage opportunity. So with the help of this model also we are able to identify if there is chances of mispricing available in the market. We need to control that and the mispricing will be removed from the market easily. Now what are the advantages of this model? Greater flexibility because we are not specific to a single factors. We are taking into consideration various other factors that gives more flexibility to the researcher as well as a fund manager to look into the factors. Empirical relevance in real world situation, when we consider about the single factor that is market return, it is not going to give better results to the researcher also. So it is more relevant that we can take into consideration the other factors that are going to affect the stock prices. No market portfolio requirement, we already know we are focusing on multiple factors, so single market portfolio is not required. Then applicability across asset classes. So there are, this is a versatile model. We can use different asset classes and look into the systematic factors that are basically affecting the particular asset. Better risk decomposition, it offers more nuanced view of risk, breaking down the returns into multiple components rather than attributing everything to the market return. So we are focusing on systematic as well as unsystematic factors if we require that. So we are, in a proper manner, we are decomposing what are the major factors that are basically affecting the stock prices. Basic limitations, difficulty in identifying the factor, that is the most important drawback of this model, because every individual are going to take different factors depending upon their need and requirement and depending upon the availability of data. That creates a problem for the final result, or we can say the final outcome. So it may vary from investor to investor as well as researcher to researcher. Then estimation challenges. Estimating the factor sensitivities and factor premiums can be complex and requires significant amount of historical data. If we do not have the historical data, suppose related to GDP or interest rate or inflation rate, in that case it becomes difficult to understand that particular or calculate the particular model. The model's accuracy depends heavily on the correct identification and measurement of factors. If it is not done properly, in that case, faulty results will be obtained, and that may not be useful for the investor or the fund manager. Potential misinterpretation. Since the model is driven by empirical data, it can be sensitive to changes in the chosen factor. Suppose I have taken into consideration only GDP and inflation, and other fund managers have taken into consideration the money supply and interest rate. So in that case, both of us are doing calculation in different manner, and it may give different results to us, and accordingly our prediction about the market or understanding about the particular stock sensitivity is different. So we are going to predict it in a different manner. So it is a complex situation for the investor as well as fund manager to understand which factors to be taken into consideration while calculating this particular model. Assumption of no arbitrage. In real life situation, we all know that arbitrage cannot be removed and arbitrage is available in the market. But they assume that if the arbitrage is available in the market, it may go on within a period of 1 or 2 days or within a day. But in real life situation, it may take time to remove the arbitrage from the market. Now application in portfolio management. Basically with the help of this we can easily calculate the portfolio and diversify which factors are basically affecting the portfolio, and on the basis of that we can easily diversify. Performance attribution, it helps in analyzing portfolio performance by breaking down returns into factor contributions, making it easier to identify sources of returns, which are the factors that are affecting the returns in positive way or in negative way. Risk management, APT allows investors to identify and manage factor specific risk, helping to reduce exposure to undesirable risk while maintaining exposure to desired factor. Suppose interest rate is affecting badly the stock prices, we can take that into consideration and try to mitigate with the help of other financial instruments. Asset pricing and valuation, it is used in pricing individual securities and estimating the cost of capital, especially when CAPM single approach is used. So firms can also use this particular model for equity valuation and can take into consideration how to calculate the cost of capital of the firm. Now this is a basic simple numerical. We have given all types of information in this numerical. The risk-free rate of return, that is RF, is 2%. Factor premiums is given 4% and beta value is 1.2. Factor 2, that is inflation premium, is 3%, beta value is, in case of factor 3, the premium rate is 2% and beta value is 0.5. Now we simply put this into the formula. We can get RF is 2%, 1.2 multiplied by 4%, 8, that is factor 2 multiplied by 3%, factor 3 multiplied by 2%. So we get that particular the rate of return, or we can the expected return of the stock is 10.2%. So this is a simple calculation. On the basis of that we can analyze how particular stock is moving in the market and what is the impact of different factors. Here we have taken different factors like GDP, inflation and interest rate into consideration, how these are affecting. So this is the formula we have already gone through. Now this is another case where we have inflation rate, interest rate and GDP. The sensitivities are already mentioned, the factors premiums are already mentioned. So now simply put into the equation, we got 11.4%. Now what's the explanation of this 11.4%? The expected return of stock A according to APT model is 11.4. Now, this particular return accounts for risk-free rate and sensitivities of the stock to three identified factors. What are the three identified factors? GDP, inflation and interest rate. So, interest rate 3% represent the baseline return for bearing no risk, serving as the time value of money. So, we require this particular 3% from a particular stock. If it is more than that, then it is good for us. GDP is 6%, indicates a high sensitivity to economic data or economic growth, suggesting that stocks' performance is strongly influenced by GDP changes. Inflation contribution is 1.2%. It shows a moderate impact of inflation on the stock prices. Simply interest rate impact is 1.2%. Reflects stock is sensitivity to changes in interest rate, indicating the changes in borrowing cost can affect its return. So if the interest rate increases, then automatically the stock prices or stock return changes. So with the help of this APT model, we can understand how the beta values of different factors may affect the stock return, and we need to understand which factors is having a highest impact on the stock return. With the help of regression equation, or if we know the simple regression with the help of Excel also, we can calculate all these things. In this particular example, it is given, but if we do not have the data, we simply put the data in a regression equation and we can calculate the beta values and are able to understand how these sensitivities are affecting the stock prices. So with this, we come to end of this particular topic. Thank you.